In the ever-evolving arena of global trade, where economic giants vie for dominance and influence, the recent developments between the United States and China have once again captured the world's attention. As the curtains rose on the latest round of trade negotiations in Geneva, a climate of skepticism loomed. The specter of past confrontations and unresolved tensions cast a long shadow, but the outcomes of these talks reveal a narrative of cautious optimism, strategic maneuvering, and the intricate dance of diplomacy. The origins of this trade saga date back to the early days of the Trump administration. It was in 2018 that the initial salvos of tariffs were fired, with the U.S. imposing a 20% tariff on Chinese imports. This move marked a significant shift in U.S. trade policy, targeting commodities like steel and strategically critical goods such as solar panels. The Biden administration, upon taking office, chose to maintain and even expand these measures in certain areas, signaling a continuation of a more protectionist stance. Fast forward to the present, and the trade skirmishes have escalated into a full-blown economic conflict. In February of this year, the Trump administration imposed a sweeping 10% tariff on all Chinese imports, a decision that would ignite a tit-for-tat exchange of economic blows. China responded swiftly, slapping tariffs on U.S. coal, liquefied natural gas, crude oil, agricultural machinery, and large displacement cars. The stakes continued to rise, with both sides engaging in a relentless cycle of tariff hikes, culminating in a near cessation of bilateral trade. Amidst this backdrop of economic brinkmanship, the Trump administration projected confidence, asserting that China's need for access to the American market far outweighed any reciprocal dependency. This assertion was grounded in the substantial trade deficit that existed between the two nations. The prevailing belief among many economists was that a trade war would disproportionately impact China, given its reliance on exports to the U.S. The Peterson Institute for International Economics estimated that in a scenario where both nations imposed a 60% flat tariff on each other, China's GDP would contract by $770 billion, compared to a $327 billion shrinkage for the U.S. However, the realities of the trade war have defied these initial expectations. Beijing's firm stance of not making concessions until tariffs were lowered forced a reevaluation of the American approach. Treasury Secretary Scott Bessent's admission that the tariffs were unsustainable marked a rhetorical shift, and President Trump himself began advocating for lower tariffs. This pivot was likely influenced by the negative market reactions and dwindling approval ratings linked to the administration's economic policies. The Geneva negotiations, held over the weekend, marked a potential turning point. The joint statement released on Monday morning revealed a significant reduction in tariffs, with the U.S. agreeing to lower tariffs on Chinese imports to 30%, while China agreed to a 10% tariff on U.S. goods. This reduction, although temporary and limited to a 90-day period, signals a willingness from both parties to engage in more substantive trade talks. It is crucial to note that the new tariff rates remain significantly higher than pre-escalation levels in the global average. Specific tariffs, such as the 100% tariff on Chinese electric vehicles, remain in place, and China's export restrictions on certain goods, including rare earth metals, are not addressed in the agreement. Nevertheless, the reduction represents an improvement, and the positive market response reflects a cautious optimism that a more comprehensive deal may be on the horizon. In the subsequent press conference, the tone was notably diplomatic. While emphasizing the pursuit of supply chain independence in strategic industries, Bessent highlighted the desire for balanced trade rather than decoupling. Interestingly, there was no discussion of currency manipulation, a long-standing point of contention between the two nations. The possibility of purchase agreements, where China would commit to buying specific U.S. products, was also raised, suggesting a potential shift toward a deal similar to the Phase 1 agreement of 2020. The proposed deal, while politically advantageous for President Trump, would likely have limited impact on the broader global trading order. It would address some aspects of the U.S.-China trade imbalance by ensuring Chinese purchases of American goods, but it is unlikely to achieve the more ambitious goals of reindustrializing America or fundamentally altering trade dynamics. This complex and multifaceted issue invites further exploration and analysis. As we navigate the intricacies of international trade, it is essential to remain informed and discerning. With a multitude of sources reporting on these developments, how can we ensure that we're not swayed by biased narratives? This challenge underscores the importance of platforms like Ground News, which provide transparency and insight into media bias. By presenting stories with a clear breakdown of political bias and ownership, Ground News empowers us to better understand the forces shaping the news we consume. As this trade narrative continues to unfold, we encourage you to delve deeper, explore diverse perspectives, and engage with the issues at hand. If you found this analysis insightful, please consider subscribing to our channel. Your support allows us to continue providing in-depth, nuanced coverage of critical global events. We also welcome your thoughts and opinions on these trade developments. How do you see the future of U.S.-China trade relations unfolding? What impact do you believe these negotiations will have on the global economy? Share your views in the comments below, and let's foster a vibrant discussion. In a world where information is abundant and perspectives are diverse, staying informed and engaged is more important than ever. We thank you for joining us on this journey of exploration and understanding, and we look forward to bringing you more insightful content in the future. Don't forget to like, comment, and subscribe to stay updated on the latest developments in global trade and beyond.